First of all, I want to emphasize that what I'm discussing today is directly related to everyone and is of great importance. I'll take you through three main points. The first is how our wealth is being diluted. The second is why the poor tend to get poorer, while the rich get richer, exploring the underlying rules and secrets of wealth distribution in society. The third is how ordinary people should respond to this. I will explain these topics starting from fundamental logic, looking at both micro and macro perspectives. This won't be a short video, but I assure you it is valuable and worth watching to the end, as it will significantly enhance your awareness. Let's start by discussing money. I want to ask you one question. Do you think you understand money? For many, the concept of money is simply cash used for purchasing items. However, at its core, money is merely a general medium of exchange. In the earliest days, there was no such thing as money. Initially, trades were conducted through barter. For example, I might trade a cow for a sheep, or a bag of apples for a bundle of firewood. Yet this type of trading often led to value inequality. For instance, if I felt that trading a cow for a sheep was unfair, how would we measure the different values of items? This need prompted the creation of a general medium of exchange, or currency. In ancient times, people used shells as currency. For instance, 10 shells for a large fish or 8 shells for a piece of pork. This allowed for pricing every item. With currency, the issue of value disparity was resolved, enabling goods to circulate more efficiently. As human society rapidly developed, currency evolved from shells to coins made of metals, then to paper money. Regardless of its form, the essence of money remains the same. It serves as a general medium of exchange to facilitate transactions. I hope you remember this. Money itself has no intrinsic value. Its worth depends on what it can be exchanged for. Think about your cash. It's really just paper, with its value being an artificial construct. After humanity entered the industrial age, societal wealth began to grow rapidly. Precious metals like gold and silver couldn't meet the demand for currency, leading to the advent of paper money. Its low cost allowed for mass printing, addressing currency needs. However, the ability to print money indiscriminately also paved the way for inflation. Inflation occurs when the quantity of money issued surpasses the actual needs for goods in circulation, causing currency devaluation. Simply put, when there's more money in society, its value diminishes. Let me illustrate inflation with a relatable example. Imagine a small seaside town where only cattle are sold, using shells as currency. If the town has 100 shells and 10 cows, the price of each cow would be 10 shells. This is a normal market condition. But if more shells are discovered and the total number increases to 200 shells, while the number of cows remains the same, the price per cow will rise to 20 shells. This demonstrates inflation. In reality, every product in that market reflects our larger market of goods and services. The total number of shells relates to the total money circulating in the market. Generally, the number of goods available and the amount of money in circulation needs to maintain a relative balance to keep prices stable. However, if banks begin to print excessive amounts of money, this balance is disrupted, leading to inflation. Inflation is a constant presence in our lives. For example, in 1950, a gallon of milk in the US cost about 80 cents. Today, it's around $4. Similarly, 1 pound of pork chops cost 61 cents in 1950, and now it's about $3.29. The price changes of these items, despite their consistency in supply, are influenced mainly by inflation altering currency's measurement standards. The biggest impact of inflation on ordinary people is the continual dilution of their money. However, due to the mild inflation experienced in the US over recent decades, this dilution process extends over time, making it less noticeable. Consequently, many people vaguely sense inflation's existence and understand it dilutes their wealth, yet they subconsciously fail to recognize its severity, becoming oblivious to its implications, putting them in a boiled frog scenario. Let's ask ourselves, if you have $10,000 now, would you want to know its worth in 10 years? To find out, we need to understand our country's inflation rate. Generally, those with economic awareness look at the Consumer Price Index to gauge inflation. The CPI tracks price changes in common goods and services like food, tobacco, medical services, and transportation. It's typically released on the 9th of each month and can be seen on the National Statistics Bureau's website. Here's the CPI change rate for the US in 2021, 2022, and 2023. 4.7%, 8.0%, and 4.1% respectively. If you had $100 in 2021 and held on to it until 2023, its purchasing power would shrink by approximately 15%. However, in tangible terms, the rate of currency devaluation often surpasses the government's reported figures. Achieving financial balance is not always straightforward. To discern the truth, we need a more accurate calculation. By subtracting GDP growth rates from M2 growth rates, we can derive a closer estimate of the actual inflation rate. M2 refers to the overall money supply, essentially the total of liquid cash in the market and in banks. GDP refers to the annual monetary production or consumption within the country. Let me break down the formula. Essentially, governments need to issue more currency each year as the total value of goods increases. If the number of goods rises while the money supply does not, deflation could occur, harming the economy. Therefore, as long as the yearly increase in money supply aligns roughly with the growth of goods, prices remain stable. However, if the money supply grows faster than goods, inflation will manifest. Let's consider another simple example. Suppose last year our entire society produced 100 goods with $1,000, making each item worth $10 in equilibrium. This year we produce 120 goods, but the money supply jumps to $1,300, raising prices to $10.8. Thus, this indicates an 8% increase in prices. To find the accurate inflation rate, you need the annual M2 growth rate minus the GDP growth rate. I've shared this formula for future reference in discussions about economic topics. Now, you might wonder why governments print so much currency. To understand this, we must delve into macroeconomics. Firstly, we must grasp that our society's total output is continually growing. Economic prosperity stems from money circulating within our society. Here's a simple example to illustrate economic flow. Imagine I am a beekeeper with $200 and you raise ducks. I use my $200 to buy 10 ducks from you. You then take that money to buy 20 melons from a friend. Your friend uses that money to buy honey from me. This $200 circulates among us. In this cycle, we each perceive that we have gained $200. Yet fundamentally, it's the same $200 circulating. The act of this currency flow generates value and satisfies our needs. This daily economic flow enables the overall economy, wherein your spent money becomes someone else's income, and that person's expenditure further benefits another. Therefore, the faster a nation's currency circulates, the more value it creates, leading to a prosperous economy. Conversely, sluggish circulation can hamper, even stagnate, economic growth. During the COVID-19 pandemic, many governments adopted lockdown measures. People stayed home, severely disrupting currency flow and resulting in a decrease in overall economic output. Businesses lacking cash flow pose significant risks. Larger companies might survive, while smaller ones could face bankruptcy. Some companies resorted to layoffs or salary cuts, leading to reduced spending, which in turn exacerbated the decline in economic circulation. This created a vicious cycle detrimental to national economies. It's no surprise that during the pandemic, business failures, soaring unemployment rates, and fractured supply chains repeatedly occurred worldwide. To mitigate such crises, governments often resort to the straightforward option of printing money. In March 2020, the U.S. government enacted a $2.2 trillion economic stimulus package, essentially printing money to stimulate the economy, marking the largest economic stimulus in U.S. history. Meanwhile, the Federal Reserve worked overtime printing cash, while the government injected funds into companies, providing financial lifelines. They also distributed $1,200 directly to American adults, enabling consumer spending and restarting economic circulation. Similarly, after the pandemic, various governments issued vast amounts of consumer vouchers to revive economies. Beyond pandemic responses, countries often resort to printing money during economic crises. However, governments aim to maintain a delicate balance. Excessive money printing can lead to severe inflation. Zimbabwe's hyperinflation a decade ago is a classic example, where purchases required a bag of money and people measured cash by weight or thickness instead of counting it. Some even used cash as toilet paper because its value plummeted. From a government's perspective, moderate inflation can be beneficial, as it encourages spending and accelerates money circulation. Yet for ordinary people, inflation consistently dilutes the value of their currency. However, it's crucial to understand that each wave of inflation is essentially a redistribution of societal wealth, which further widens the wealth gap. Consider two people. One has $10, the other has $100. Which of them suffers more in inflation? Many might assume the richer person faces greater loss because their money dilutes more. While this viewpoint has merit, the reality is that the wealthier individual's money typically grows while the less wealthy shrinks. This phenomenon arises from two main reasons. First, wealthy individuals typically possess different financial strategies. For them, inflation's impact is minimal. They are often financially savvy enough to convert cash into appreciating assets, such as real estate or stocks, anticipating inflation's effects. As inflation rises, these assets increase in value, effectively providing them armor against inflation. If returns outpace inflation, they benefit even more. By contrast, ordinary individuals often lack investment knowledge, merely saving cash in banks, earning low interest that doesn't compete with inflation. Thus, their money continues to lose value. Second, people with assets often recognize a crucial principle. Debt can equal wealth. To understand this principle, consider the flow of money. Initially, currency is printed by central banks and funneled to commercial banks, which then lend to businesses and individuals. Those who access these funds first are typically wealthier individuals or their companies, as they possess collateral. Banks prefer to lend to them to mitigate risk. When wealthier individuals receive funds, they often reinvest some while holding the rest for personal investments. With low-interest loans, it's easy for them to find higher-yielding investments with minimal effort. As inflation progresses and devalues currency, debt becomes progressively easier to manage. Therefore, for those who control enterprises, incurring debt can be advantageous. Furthermore, money flow takes time to influence the marketplace. Initially, businesses spend new funds based on prices before inflation takes effect. By the time these funds reach regular consumers, inflation has risen, compelling them to purchase at higher prices for goods produced at pre-inflation costs. With this understanding, you can see how wealth dilution occurs progressively. But here's the good news. It isn't all negative. Many ordinary people harbor a fear of debt. Should your region experience inflation, a pace exceeding interest rates, substantial loans can be a powerful defense against inflation. As previously mentioned, inflation continuously dilutes debt, meaning payments become easier over time. You would be repaying a loan with income adjusted for inflation, which diminishes your repayment burden. Regarding large expenditures during periods when rates cannot outpace inflation, my advice is to opt for loans, even if you can afford to pay in full. Let time and inflation work in your favor. Picture wealth as a bucket. Many think that if they pour water into the bucket, it will fill up. However, inflation acts akin to a leak. Any effort spent filling the bucket is futile if wealth keeps draining. Thus, regardless of hard work, the bucket never fills adequately. Wealth-aware individuals, conversely, focus on earning, converting their funds into appreciating assets, and benefiting from compound growth. Their buckets don't leak. In fact, their assets appreciate. This results in a positive cycle where their wealth continuously grows. To remedy these issues, one must first alter their perception of money. Your second task is to cultivate an investment mindset. Don't just develop awareness. Take early action within your means. Your primary objective should be to grow your money faster than inflation, rather than watching it diminish in a bank account. Establish a fundamental allocation strategy. Divide your money into 3 areas. The first is for short-term needs like monthly expenses, which can be kept in low-risk funds. Although the yield may be low, it's better than nothing. The second portion is for value preservation, aimed at medium-term needs. Consider investing in assets like gold or bonds designed to hold value. Gold is a hard currency, rising with inflation and offering high safety. Bonds or long-term bond funds yield about 6 to 7%, reasonably offsetting inflation. The final third should be dedicated to genuine investments that aim for high returns, over 10% annually. If you achieve this, your money will benefit from compound growth, paving the way for financial independence. If you're unfamiliar with high-return investments, I'll discuss them in future videos. In essence, investment categories generally fall into two types: those that appreciate on their own, like low-risk bank products or bonds with lower returns, and higher-risk stocks. For higher yields, consider riskier investments, but be mindful that stocks may not be suitable for everyone. Indeed, inexperienced investors might face losses. Thus, a sound option is to invest in index funds. Index funds are basically stock-based funds with lower risk than individual stocks, and their long-term returns can comfortably exceed 10%. However, unlike low-risk products, they require some understanding of investment strategies. If you know little about investments, rushing might lead to losses. Some perceive wealth concentration as wealthy individuals preying on the less fortunate. However, acquiring wealth can resemble a zero-sum game, as humans instinctively pursue personal gains embedded in our nature. Hence, when certain individuals master wealth acquisition strategies better than others, they naturally accrue more wealth, while those unaware will see theirs diminish. This is a natural cycle, and switching positions would likely yield similar behavior from you. Wealthier families often prioritize financial education for their children, understanding that wealth maintenance relies on knowledge. Thus, many affluent offspring grasp the essence of money and its rules from a young age, granting them an advantage over peers. In contrast, many working-class parents may overlook financial education, leaving significant gaps in knowledge for many young adults. In some aspects, it's vital to recognize that many parental figures may not possess perfect knowledge. When you return home for family dinners, your parents likely attempt to impart wisdom, often shaped by outdated beliefs or misinformation. It's essential to appreciate this intention, as their understanding was limited by their backgrounds and time periods. While they provide invaluable lessons and guidance, it falls on us to proactively change our circumstances. A suggestion is to dedicate some of your free time to learn economics and finance. Understanding economics allows you to grasp the societal wealth distribution and operation mechanisms better. When you elevate your perspective, future decisions become clearer and more precise. If you like this channel, please click to subscribe. I will continue to create original content for you.